Hey guys, welcome back to the channel. In this video, I want to react to what Tom Lee had to say on CNBC. He's talking crazy again, but hey, the guy has been right the last 20 months, so when he talks, you have to listen. Tom Lee is a former chief equity strategist from JP Morgan Chase, and now he owns a research firm called FundStrat, where he provides research to hedge fund managers.
Well, Tom, speaking of equities, I'm going to do something rare, mostly because it's funny, and give you a hard time for not being bullish enough. 6 weeks ago, you warned about a potential 10% pullback in the S&P in the next 8 weeks. We're up 6.5%, I think, since then. Now, you did say to buy any dips if that were to happen, but do you see any more potential icebergs? What do you think got us this far?
Well, John, the stock market in the last 6 weeks has proven its character, which it's had all year. The S&P is incredibly strong this year. It's been up now 9 of 10 months. And you're right, we got fooled by seasonality because I figured, well, between now and election day, there's a heightened possibility of some type of correction. We weren't saying you want to sell stocks. I think it's always a mistake when people panic sell, because we, literally in the same paragraph, said, but if it does pull back, you want to buy that dip. And I think we're still in that tricky period until after election day. But that doesn't mean I think investors should be bearish right now. I think we have a really good fundamental backdrop. I mean, look, if David's view is correct, 3.5% 3.5% Fed funds rate is very supportive of the economy. It's going to really take housing and autos and durables out of a recession, and that should be good for.
I just want to pause right here, guys. I know Tom Lee said rate cuts should take housing out of a recession and autos too, but as far as housing, the Fed just cut interest rate by 50 basis points and mortgage rates went up. So that means buyer demand is going down, and buyer demand has been to its lowest level since 2019, even lower than the 2019 numbers. So I do agree that when Fed cut rates, the housing should do better, but at this moment, it's currently not.
Not only earnings growth, but for PE multiples. So to me, all of this, I think, is a pretty good backdrop. That doesn't mean turbulence couldn't happen. So, Jod, I guess, I think people kind of view the idea that there could be caution as like a dirty word. It shouldn't be. I mean, this is a stock market, and people should be prepared to buy dips if there are.
Yeah, and we're coming into the 2 weeks of peak earnings season, Tom, to your point. Plus, right behind that, we do have this election. So the next couple of weeks will be ones to watch here for investors. You just mentioned housing, though, Tom, and I do want to get your call on that because you're bullish on the home builders, and you say there's historical precedent for this.
Yes. The reason we highlighted the trade today is that since 1999, believe it or not, there's a 6-month window when home builders enter a golden 6-month period. It's something we've been writing about at FundStrat for a better part of a decade, and the trade's worked 12 of the last 15 years. But from October 20th to April 29th, home builders have outperformed the S&P by an average of almost 1,900 basis points. So all of the gains home builders make typically occur those 6 months. I can't explain the seasonality, but the backdrop is better today because the Fed is cutting at a time when there's pent-up demand. And the home builders have actually done a very good job of capital management. So to us, it looks like a trade that should work this year.
I'm bullish on the market, but we do have to tread lightly because the market is up about 21 to 22% this year. And I just feel like there's a pullback coming eventually. I know 2022 was pretty rough where everything was started going down, but as we're starting to get new data, we have election coming up. We do have CPI and then job report. So we have to see how strong the economy is and how the 50 basis point cut is working its way into the economy. At this point, I'm still staying invested in the market, but I would tread lightly just in case there's more downside in the future.